to episode 51 of Top of Mind with Consilio Wealth. Today is Tuesday, June 18th, 8:12 in the morning Pacific time. And on today's episode, we're going to be talking about commercial real estate delinquencies. That's been in the news a lot. We thought we would dig into the data and see if it's really an issue yet, and just what the data is saying. The trend of inflation, I think you all will find this quite interesting. The trend that it was, and if it stayed on that trend of basically 2% versus this big jump in prices we've all experienced the last couple of years, and how that sets us on a new track. Super interesting stuff there. Number 3 is, when's the worst time to sell? I think Hao's answered that as always, and I think he's right. Side note, Hao was recently quoted in an article, and so we thought we would highlight that on today's pod. Maybe you all saw that in our email list as well. And finally, number 4, it's been smooth sailing in the markets. Really, really low volatility. That's measured by the percentage of 1% movement days, 2% movement days, 3% movement days, etc. So we thought we'd share some interesting stuff with you on that today as well. Hao, where should we start?
You want to start on your video, the HSA one?
Yeah, we can do that.
Okay. All right. So I was watching Chris's video on HSA, and there's just a lot of knowledge bombs, I guess, even for someone in the industry like me.
So if you're not following us on YouTube, definitely do that. You might be if you're listening to this, but you might be listening to this just on the podcast format. We release this both on YouTube and on podcast. But we have a separate playlist on our YouTube channel called Consilio University. That playlist is all about 2 to 8 minute videos or so on a financial topic. So most recently we covered HSAs and how to best utilize them in 2024. Top highlights: tax-deductible contributions, tax-deferred growth, tax-free withdrawals. Invest the money once you get the money in there, and you don't have to use it all right away. You can put money in your HSA, pay cash for medical bills, and then take money out of your HSA many, many years down the road to refund yourself for that medical bill. Of course, after that money has grown and compounded for a bunch of years in market. So definitely tune into the full video for the full take, but Consilio University releases weekly on a super good financial topic.
That's what they mean by triple tax advantage, right? The money going in, the money growing, and the money coming out, all tax benefit in one form or another.
And it's the only account that is deductible on the way in and tax-free on the way out. You know, everything else is one of those, right? It's tax-free on the way out, but you don't get the deduction on the way in, or it's deductible on the way in, and you got to pay tax on the way out. So everything else has sort of a different take on it, but the HSA, you get it from both sides. And if you don't use your HSA, it turns into a regular IRA after age 65 too. So you don't so much have to worry about, am I going to have medical expenses later? If no, just use the money in retirement.
Yeah.
It's not tax-free in that case. It's kind of like a regular IRA, but that's fine too.
Yeah, you're most likely retired, lower income.
Sure.
Most likely,
exactly.
Right? Yeah.
Exactly.
All right. Good stuff. Check out the video.
Check out the video.
All right.
All right. So, yeah, let's kick it off with our first topic here. So, commercial real estate delinquencies. This has been in the news a ton, so we decided to look into it. And Hao, what did you find here?
I think it helps to set up the broader, doomsday scenario, at least from the media portraying that everyone's working from home, commercial buildings are empty, and that might be true in your city or not. I know there's repurposing in the Sacramento area, probably not as quick as we'd like, but repurposing the buildings for different uses. And I think there might be some validity to it, right? Like everyone's saying lots of failures are coming, right? And I think that's going to implode on the commercial building owners, the people who provide the loans, right? And the people who potentially occupy some of these half-empty buildings. And I think we kind of believe that too. Kind of. That's why we have investments in real estate. I mean, we've always geared them towards non-commercial purposes, right?
Mm-hmm.
But the data from the Biz Journal saying the slowing rate of delinquency, or yeah, that's a good sign, right? Like the rate of delinquencies are slowing, which the rate of delinquencies overall is historically low, even before 2005, 2006, which that's the last time we had that trough, and it spiked up in the great financial crisis in 2008, 2009. But that was at 7.5 at the peak. We're looking at, I had to squint to look at what this number is. It's like less than a 1.
Less than a 1, yeah.
Yeah. And post-pandemic in 2022, we had a 0.6 rate. I'm literally squinting here. It's a 0.6 rate. Now it's up at as of the first quarter 2024, it's like 1.1. So to me, it's like a lot of it made out of nothing. It's seeming like, hey, word on the street is, but the data is not really backing any of this up in terms of a commercial real estate apocalypse.
Yeah, so far. I mean, what's interesting here is that if you look at the 2008 financial crisis, so I'm just looking at this chart. So it started to uptick, looks like around like maybe late 2006, early 2007. Like it started to go up. And that was sort of, we all know now was a problematic time. But at that time, things were still going up, right? Markets were still appreciating, sentiment was still good. And ultimately, commercial real estate delinquencies and just real estate delinquencies, period, kind of led us into it. And then that spiked to, that's like 9%. That's a big number. It didn't actually recover and get all the way back down to the low. Really until right pre-COVID. The biggest part of this mountain here with the big spike kind of went away by like 2016. That's a long time.
And that's, to be clear, that's delinquencies. I don't know what the value of the actual value of commercial real estate. I'm sure it's gone down a tick, but it's not imploding, at least in America.
So I think that also, at least in part, speaks to values are holding. Because often, I don't know how often, and maybe that'd be an interesting point to dig into, but at least sometimes, companies and real estate firms will go delinquent on a building on purpose because they're trying to get a restructuring agreement. And so, if they owe, just simple numbers here. Let's say they owe $1 million on a building, and previously it was worth $2 million, but now it's only worth $800,000. Let's imagine there was a big decline in the value of the building. It can be strategic to go delinquent on that loan because then that opens up negotiations with the lender. The lender might ultimately restructure the loan for better terms. They might float the rate differently. Let's say it was a variable rate, right? They might give a better rate, and they might actually lower the loan balance because ultimately the lender doesn't want to charge off the entire loan. So delinquencies, I think, back in the 0809 crisis were in part doing that too. It was loan restructuring and trying to say, I own 2 or 3 times as much debt on this building than it's worth. Certainly values have changed throughout the last couple of years here, but possibly the lack of the uptick in big delinquencies could be due to a lot of the values have actually held up better than maybe we all thought. People are traveling again. People are staying at hotels again. Office might be struggling a bit, but I've even read that, Class A top location office space is in higher demand today than it ever was before because companies are trying to lease exceptional space for their employees, 3 days a week or whatever.
Yeah, I think a lot of it has to do with possibly ego, right? We have a performance chart of various REITs, and they're all pointed towards like the commercial real estate area. SL Green is like the New York based REIT. They're up 131% over the last year.
Wow.
And again, before you go jumping in, it's like, oh, that's a great turnaround. They're still down over the last 3 years by 10%. So even after this 131% pop, there's still a loss. But I think to Chris's point, there might be ego involved there, right? Because you want the gem of New York, right? You want an office space overlooking the city, or if you're a big CEO, you want that corner office overlooking Central Park or something, which, SL Green does own a lot of those primo spaces that everyone wants. So if there is an implosion, I know San Francisco comes in the headlines a lot of, becoming a ghost town. It isn't. Let's be really real here. There's going to be a floor, and it's probably higher than everyone thinks. A lot of money swimming around, and a lot of ego, right? Because if you're a relatively startup company, you want a primo location to attract or to just show off. It might be as simple as that.
Yeah, it's an interesting thought. Yeah. I've asked a couple people, in traveling recently, where are you from? Oh, I'm from San Francisco. I'm from the Bay Area. Really? Is it as bad as the news says? Like I'm asking people, and I'm generally hearing no. There's pockets like every city, but it's not as bad as one thinks. And maybe I need to go see it with my own eyes. I mean, we've all, I'm sure, seen the news of like the big box retailers totally leaving the city and that kind of thing. And it's like, God, there's no Macy's in the city anymore. Where do we go? And I don't know if there's a Target there anymore. And T-Mobile's pulled out, and all this stuff. And so like maybe it's one of the things that I need to kind of go see on my own, because don't believe everything that your Instagram feed pushes to you. But I think in general it's not imploding as badly as maybe the media is saying.
And it hasn't returned to its previous highs pre-COVID. For sure. But again, it's nowhere near death.
Yeah. There's a couple of restaurants that we like, that we've gone to, a couple times on a few trips down there, and you'd imagine that those restaurants would be closing or they wouldn't make it or something, and I haven't gotten any notices of that either. So that's, again, good news. People are still patronizing businesses, they're still going out, but it's not like these once great places are all gone.
No, I think that city will recover. I think most major cities will recover.
Yeah. So you've got a trailing 12 chart on all these REITs here, and then you've also got a 3-year trailing chart, and that's actually pretty wild to see. Why don't you rattle off these returns of the 3-year trailing on these? Yeah,
and I think the point of the performance here is if you think there's a doomsday scenario for commercial real estate, I think the market's already beat you to it. So the trough already occurred in 2022, 2023, but the returns over the last year, let's pick the top 3. SL Green, which is New York based, right? Those primo New York office buildings, up 131% over the last year. Simon Property Group, which is mostly retail space. Like everyone says malls are dead, up 45% over the last year.
It's mostly malls, and notably they own Northgate Mall. So they own some very top properties that they are working to redevelop into more mixed-use space. So, for all of our Seattle-based listeners, they're what's behind Northgate Mall and the huge redevelopment into, office, retail, hockey arena, all that stuff.
Gymnasiums, theaters, bowling alleys. Like it's going to be more experience use, more mixed use than just selling stuff, right? And then going to the 5-year, SL Green down 9.29% over the last 5 years, even with that pretty huge bump in the last year. 130% is nothing to sneeze at.
Wow.
CBRE, which is, I would say, a combination of office and retail, up 80% over the last 5 years. Simon Property Group, up 24% over the last 5 years. The trough, as I mentioned, happened in 2022, 2023. I think that's when the market really focused on the commercial doom, right? And I think we're in the midst of a recovery in terms of the stocks, not right, because the data from the Fed, the St. Louis Fed, with the delinquency rate, there's no delinquencies to be mentioned. I had to squint to see what the rate is. I'm not seeing anything other than my own eyeballs, right? I see empty buildings too. I'm not blind, but I don't know what's happening financially with the lenders, with the landlords. It seems healthy. If anything, it was impacted in 2022, 2023.
Yeah, I just wonder how isolated it is, right? I mean, I've certainly seen in the news there's a few prominent developers and real estate investment companies in the Seattle area that have certainly been in the news a decent amount for, either not paying their loans because they're hoping for restructuring, or even just like saying, hey, we don't know if we're going to make money the next handful of years. All this stuff has been in the public news. And so I think that, I agree with you, right? It's not like this is bankrupting, hopefully, but there certainly are holes in leases. If you went from you were 95% leased on average to, maybe you're in the 60s or 70s, that's problematic. I mean, it's why generally these companies have targets around how much leverage they take on their buildings so that they don't take, 70% leverage. But if they're, below 50, that asset is still relatively safe. Now, in the face of a restructuring loan where the loan interest rate's going up, therefore the payment's going up, your rent collection is down, yes, that's problematic. But it seems like those buildings are a little isolated, and then the real estate companies are trying to work with the lenders to charge off some of those loans and do some restructuring agreements to allow for some breathing room. So that seems like that's the current status right now. But, as we would always say, we'll just have to wait and see. But seems like it's playing out not as bad as was previously thought, and possibly that's starting to get reflected in some of these stock prices in the trailing year. Yeah, because they're doing fine now. Well,
probably coincides with interest rates peaking, right? Because over the last year, interest rates did not go much higher.
Yeah, that's fair.
They plateaued. And, commercial real estate and real estate in general is relatively sensitive to interest rates.
Yeah. Let's move to inflation. This chart hit our inbox here, and this is just crazy. So this is a chart here of the normal trend of 2% versus the trend that inflation has been on since COVID. So, Hal, why don't you unpack what we're both looking at here for our listeners?
Yeah, I guess a bit of a mea culpa is like when we looked at consumer sentiment and we just couldn't understand why people were so unhappy with how things were going financially and in their personal lives. I think this answers it, right? So when we talk about inflation, it's the rate of change of prices. So if the cost of the Big Mac goes to $10 this year, but next year it's still $10, we're going to report to you that inflation was 0%, because the price of the Big Mac was $10 this year, and then next year, zero inflation. If it went up to $11, that's 10% inflation. You see how that works?
Yep.
But you're still pissed at me for ignoring the fact that the Big Macs are $10 when everyone's used to paying $3 for it, right? That sucks.
Yep.
And so a bit of a mea culpa on my part, where I was like, hey, we should fire the survey takers who are measuring consumer sentiment, because yes, rightfully they're pretty peeved about just generally higher prices, the price level. Who cares what inflation is? I'm paying $5 a gallon in gas. If it's persistently going to be $5, at what point am I going to be okay with that price? It's most likely if my income is matching or exceeding that rate, right? Yeah. And I'm not so quite anchored to $3 gas. That could take years. And what this Goldman chart is showing is this spike of inflation relative to trend. So if we stuck to that 2% trend, prices would have been higher, but they would have been higher only by 9%.
Since when?
Since 2021. Right?
So this chart, since from 2015 to right about 2020, was almost a perfect 2% every single year inflation. And then COVID happens and we fell below that trend, right? Prices actually crashed for a period of time. Then about a year later in 2021, they started to skyrocket, as we all know.
Yeah.
So if we stuck on the trend, you're saying 2021, we would be up how much? And then how much are we up actually now?
Yeah, if we stuck up on the trend, it would have been at that 2%, like up or down, right? Give or take, where inflation was not on in anyone's minds. We would be facing 9% higher prices, but it would have been gradual, right? I don't think anyone would have noticed.
Sure, yeah.
Right? Because prior to 2021, has anyone really mentioned inflation?
Not for a long time.
Right? So that bump that's reality that we're experiencing, prices are higher by 21%. And that's the new trend, right?
Wow.
So, well, we've argued that prices going down is probably a bad thing. I know people might be relieved by that, but think of it as a producer or business owner point of view. Let's say you have to cut prices of your products by a significant amount. You're probably going out of business because what else had to follow that, right? You had to
Wages.
pay your wages.
Yep.
You can't just turn around and say, hey, we had to lower our prices by 10%, therefore I need to cut your wages, Chris, by 10%.
Yeah.
That's not going to fly. And I think that's what I mean by that time taking place, where people have to re-anchor their expectation to higher prices, which is completely different from inflation. So when we mention inflation, a bit of eye rolling because we're talking about the rate of change of price, right?
Mm-hmm.
Not the price level. And we probably don't spend enough time speaking about how much higher prices are. We've always been focused, like the Fed.
The rate of growth.
Yeah, the rate of growth.
Really good point. Because prices aren't really going to come down in aggregate. I mean, we've talked about eggs and we've talked about cauliflower on this podcast. Cauliflower is cheaper today than it was, so some prices have gone down. But on the aggregate, if you look at, say, all vegetables or all proteins, that kind of thing, they're still up. And I think the most interesting thing you said there is that we're so focused on the rate of change. So if we grow from today by 2% or 3%, isn't that a win? Okay, that's a win because the rate of change has gone back to trend. But we've already jumped from, we should be plus 9%. We're plus 21%. We've jumped so far that now that creates a new base. The thing that should be $5.50 is $6. And the $6 price is now what's growing at that 2 or 3%, which is not good. And it's not going to come down. Right?
Correct.
It's not going to come down.
So not good in the minds of people. I think real wages have definitely exceeded at this point. Maybe in the last 4 months have exceeded inflation. So there will be a point of crossover where people won't feel it as much.
Mm-hmm,
but like I said, it's going to take quite a few years for that to suddenly bake in, where people are used to the higher rates of prices, or higher levels of prices, sorry. But you do not want lower prices, right? I wrote an article about the Great Depression where milk farmers, rather than sell the milk at discounted prices, they poured it into the streets and started protesting, right? So there's going to be pockets of industry where they're going to be almost loud against price cuts if we were going to see lower prices, right? So what that would take is probably another COVID. I don't know if you remember this, Chris, was the price of oil per barrel was negative $40.
I do remember that.
Remember, there's some sucker New York trader who had to take delivery of thousands of barrels. So he had to pay some storage facility to take that off his hands. But guess what was happening during COVID? No one was flying, no one was driving.
Yeah.
So the oil consumption was way down, supply and demand, right?
Yeah.
That's the last time we saw true deflation.
Yeah.
But that's not a good thing, right? Would you rather go back to COVID, or would you bite the bullet and pay $5 a gallon in gas?
Well, that's easy for me to say, but I think I want to come back, and I've said it here before and I'll say it again. I think the best outcome of all this stuff is wage growth, because that wage growth has primarily been delivered to the jobs that actually need wage growth, the jobs that haven't seen wage growth in the prior 10 years. And so that's been really, really good. Yes, I would not rather go back to COVID, but I think from a pricing standpoint, I think that's where some people might actually answer that yes. And I mean, it's interesting because looking at this chart, prices did actually come down a little bit right at the beginning of COVID. And, maybe the question for a decade beyond where we are today is, did we overcorrect? Did we push so much money into the economy that we tried to protect against this?
Yeah.
What? 5% drop in overall prices to then we jumped prices by double the trend?
Yeah, I think you could argue was shutting down the entire global economy an overreaction. I think in hindsight, yeah.
Yeah.
Right? But at the time, hospitals were overrun, so I don't, again, trying to erase what I know now, like in that moment, was it an overshoot? Maybe, yeah. Still, at that, even after adjusting for what I know now, there's no going back, I get it, but still, I think the solution to the self-created problem might have been overkill, but the self-created problem by locking everything down in itself was overkill. So there's like this compounding effect of, unfortunately, overreaching decisions.
Totally. All right, let's move to our third topic here. So Howe was recently quoted on GoBankingRates.com. They did an article on the worst times to sell your stocks, according to financial advisors and financial professionals. And so Howe was quoted in this actually twice. And it's posted on our website. We sent it out. And let's just talk about it. I thought the article was good, and I thought your quotes are good. So why don't you take it away?
Yeah, let's go over the quotes. Investors should be... This is me speaking to Heather Taylor, who wrote the article. Investors should be careful not to sell good stocks simply because they are down, said Hao Dang, CFA. And investment strategist.
Thanks for that nod, CFA.
Yeah, Consilio Wealth Advisors. According to Dang, this is a sign of investors giving into their emotions. Dang doesn't recommend selling stocks because of price movements. This is true whether the prices are going up or down, and investors potentially lose out on upside if they sell prematurely, even after a decent run-up. Good companies have the ability to grow and maintain their margins. To be clear, I gave them a page's worth of context and information, and they pulled quotes out that I think still apply, but I think they should they would be a lot more helpful with context. So I think never sell. Basically, I'm saying, if you're going to look at the quotes, I'm saying never sell when prices are low, and actually never sell when prices are high. So never sell, period.
Makes sense. That's the best way to make money.
Yeah. What I really said was sell to rebalance, to like address your risk. Right? If you had an NVIDIA and you have too much NVIDIA relative to your overall investable wealth, you should probably sell and rebalance, right? That's one part. Life events or financial planning dictated sales, right? You're about to head into retirement. Do you want to carry this much NVIDIA? Yes, it got you to retirement, but you don't need 200% return over the last 2 years throughout your retirement. That's a bit excessive.
Yeah.
So those sales really aren't dependent on price run-up, so to speak, because they're taking emotion out of it, but they're integrating life events into it or risk into it. So you should probably consider selling with those two factors, right? And the context of not selling when things are high, I don't know. I think Chris and I have the same horror stories for selling stocks too early. I sold Apple at $40 a share. I don't know what it's trading at now post split, but it's $200. Yeah. Let's say it's worth $5,000 a share. You know how much I'd left? Potentially $4,600 on the table per share in my hypothetical scenario, because I made, let's say, 80%, and I assumed it couldn't go higher from here. But at the time, I didn't really understand market cap distinctions, right? Apple at the time was maybe a $90 billion company, and what are they at now? $3.2 trillion. So
something like that.
Yeah, it's easier to get from, definitely using quotes here, air quotes here, 90 billion to 500 billion, 500 billion to a trillion. Is it realistic for a company to go from a trillion to a trillion? Yes, we've seen it threefold with Apple's case, but for them to double, they had to go from 3 trillion to 6 trillion. Is there that much money in the stock market in today's dollars to make that happen? I'd argue that's pretty tough, but it's getting to that point that investors miss when they just look at percentage returns, right? Because NVIDIA at a time, NVIDIA before this big run, was up 400, 500, 600%.
Right.
And they were still a relatively small company,
right.
size-wise, right? I have stories about Visa, Chipotle, right, selling after a recently good run and not really looking at the addressable market. How much further can they grow? And I think that's important for sellers, potential sellers, to look at if they're looking to, cash in some profits.
Yeah. It's interesting thoughts, right? And I think one of the best ways to mitigate this, and you talk about this too, when you buy an index like the S&P 500 or the S&P 400, which these are all different indexes that track different areas of the market, you are able to participate in those small companies becoming big companies because they move through the index by a market cap weight. And you don't have to be so stressed about, did I sell Chipotle early? Because it's in the index and it'll just sort of like grow or shrink. You comment here, if one company fails in the S&P 500, there's 499 others to prop up the index. And that's super valuable versus if you are all in on the one company that isn't the right company. And I know the right company that goes up is always so obvious. Then that can be completely detrimental to your plan.
Yeah. And I think Chris is leading us to another important point is if the advice seems to be like at one stock, I think the context of a well-diversified portfolio, I think S&P as a starting point is a great place to start. But there's more stocks than that, right? I think the beauty of an index is it's always kicking out losers and it's pumping up the winners. But if the winners don't quite win, you're still relatively insulated from a complete loss. Right.
Let's dig into the S&P a little bit more as we come to the end here. So you have an interesting chart here for the change, the timeline of changes in the S&P. So there's a bunch of colors on here. There's a bunch of stuff on here, but let's try to unpack this for our listeners who obviously can't see us. Well, they can see us, but can't see this chart.
We have a chart going back to 2010, and there's 11 different sectors in the S&P, and really depending on company market cap performance, meaning the S&P won't let $1 million company into the 500 biggest companies because
too small.
We're in the billions here. So the sectors are going to shift, right? Consumer discretionary, technology, energy, industrials, etc. So as a shift, right? Let's look at 2010. The most removed sector of the S&P during that particular year was consumer discretionary, with 4 stocks removed that year, and they were replaced by, with 4 energy stocks. In 2011, information technology was the most removed sector, with 6 companies being delisted, and consumer discretionary came in with 4. So you're always in that was one of the higher years of changes. So overall in 2011, I mentioned 10 changes, right? 6 from IT being kicked out, 4 from consumer discretionary being added, but there are 20 total changes that particular year, and that's pretty common for the S&P, where it's always recalibrating itself, so to speak, where it's getting rid of companies that no longer fit the criteria. They're either going private or they're failing, right? They're shrinking, and therefore they're getting removed. And I think this year we saw the inclusion of KKR, which is a private investment company, Super Microcomputer, and getting kicked out were Illumina and a few other names that you might have not heard of because they're not quite as successful businesses to at least stay into the index. Most recently, in 2018, we lost 12 companies and added 12 companies in. So the rate of changes in the S&P seems to be accelerating. And I don't know what the underlying cause of it is, but companies are shifting at a faster rate than what we've seen.
It's interesting here, since 2015, the most removed sector or sectors, consumer discretionary, energy, and then healthcare. Consumer discretionary has been the leader in 15, 16, 17, and 18, and then some energy and some healthcare. And those companies have been replaced mostly by IT companies. What is important to note, though, is that IT companies, so Amazon doesn't fit into IT, for example. Meta doesn't fit into IT. So those companies fall into consumer discretionary. They fall into communication services. And so there's different areas of the S&P. So I know what our listeners are thinking is information technology. That's the big 7 companies in the index. It's actually not. But what is interesting is that there's been multiple consumer discretionary companies that have been removed from the index. Yet, Amazon is classified as that, and of course they're still in the index.
Yeah, and I think with all those changes, as it evolves, that goes to putting your future on one stock. There's very low odds of making sure that one stock is the top performer year in, year out.
Yeah.
And then over time, hoping that one stock is still in the S&P, because the amount of turnover over the 5-year span has increased to about 68% of the companies listed today won't be listed in the next 5 years.
I mean, there's 25 to 29 companies swapping out of the S&P. That's 5%. 2015, 2016, 2017, 2018, it ranged between that. So, 25 companies a year, basically 5% turnover, which is interesting. Even harder is it to be the top company and then stay at the top company. You've got a chart in here about this. So this is the number of top 10 S&P 500 companies that are not in the top 10 companies 5 years later. Hard to get to the top and hard to stay at the top. So what are you seeing here in this chart?
Yeah, so the chart doesn't really notate which companies fell out of the top 5 and then jump back in. But I think a couple of things can be said about that. Is the competitive economy, right, would stop working if you're persistently the top year in, year out, right? Because guess who wants to replace NVIDIA? Everyone else who's making chips, right?
Sure.
I know Intel is pushing, AMD is pushing, and whatever unknown company that we don't see in our radar yet, they're going to supplant NVIDIA because they're making 70% margins on a lot of their graphics. That's a profit margin that is too big to ignore, right? Remember Tesla? at their peak was like 35% margins on a car.
Yeah.
So now they're down at single digits.
By the way, I recently read, I think Rivian loses $40,000 for every car they sell.
Yeah, but Rivian's a great example of competitors entering the marketplace, right? Like,
And how hard it is, yeah.
yeah, they're not all going to be successful, but that's always been the American economy, right? Mm-hmm. Like, look at Montgomery Rewards or anyone pre-Walmart, right? Or anyone pre-Amazon. Those were companies that were at one time successful. Remember Circuit City? They failed,
I
right?
do.
But it always evolves. And just because you're on top now doesn't mean regulators won't step in. That's regulatory risk. Remember AT&T when they got busted up? I know we're in a more friendly like environment business-wise, but it happens, right? If you get too big, you tend to get attention from regulators and legislators.
Okay, so I want to rattle this off here quick. So, number of top 10 companies in the S&P that are not among the top 10 5 years later. This ranges between 2 and 7. As I go back, this chart starts in 1990 and ends in 2019. So, 2 companies, 3, 3, 3, 5, 4, 4, and so on. So the average over this quite long period here, we're looking at 30, well, really 30 years on this chart roughly. The average is 4. So the top 10 companies, 4 of those are not in the top 10 companies each year 5 years later.
Yeah.
Our point with this is not to, throw dirt on the top 10 companies that are there today. It's merely just to point out that it's incredibly unlikely that those top 10 companies are the top 10 companies forever. And, if you were to Google S&P 500 companies over time, you'd see how that's changed dramatically. And yes, it's also changed because the economy's changed. It used to be GE, and then it was Cisco, and then it was Microsoft, right? And yes, it was, these different companies. Today, it definitely skews more towards tech or tech-related companies. But remember that these things change. The biggest companies of today, there could be bigger companies that overtake them in the future. And I know what everybody's thinking. It's not possible.
Yeah.
It's not possible. These companies are so big. They make tons of money. We'll just have to wait and see. But history tends to rhyme. So,
Yes.
Again, this is not us saying these top 10 companies are bad companies. They're phenomenal companies. It's just that it's likely that the leaders, the biggest companies of today, won't be the biggest companies in a handful of years. And that's, I think, the important point to understand.
Correct.
Let's end just with this super quick note on volatility. I commented on this on one of our previous recordings, and we have some data in here now. So this is just on the S&P 500 and the rate of change. And this is important. So volatility is measured on number of 1% movement days, 2% movement days, 3% movement days, 4, 5, etc. 2024, let me start with 2023. 2023 experienced 2 trading days in the entire year that moved more than 2%, 0 that were 3, 4, and 5, and 64 that moved more than 1%. That was an incredibly calm year. And I'm sure we all remember that, right? Market was up out of the gates, fell back to basically break even, and then it was kind of a slow climb all year, but it was a nice year from a return standpoint. It was an incredibly low volatile year. Compare that to the year before, 2022, which was quite volatile, right? Markets sold off most of the year with big recoveries. There was one day in 2022 that the markets moved more than 5%. 3 that it moved more than 4%, 12 that it moved more than 3%, 46 more than 2% days, and 122 more than 1% days. That actually blows away the bear market average, which is like...
That was a rough year. 2022 was a rough year.
Rough year. Blows away the bear market average by 50% in rough terms. So I just want to bring that forward to today, because we've just all experienced incredibly low volatility markets, really since the beginning of 2023. And again, history has a high probability of rhyming over time, which means that we could see some bigger movement days in the future.
Yeah.
That's okay. That's normal. That's what markets do. Remember that the volatility is the price of admission in getting that consistent, nice, long-term average that everybody's trying to achieve. So I just want to spend a minute and point that out because I think that's some interesting data.
I think a different way to say it is we're in abnormally calm times.
Yeah, totally.
You should expect, on average, a lot more volatility than we've experienced in the last, let's say, 18 months so far.
Mm-hmm.
Like, this is a really great stretch that should be appreciated.
Mm-hmm.
But in appreciation of it, I think you should address any underlying risk that you might have,
Mm-hmm.
because things, throw presidential elections out, right? Things will happen that surprise us. They always do.
They always do.
And you got to look at it as a buying opportunity. If you have cash, you probably shouldn't have cash on the sideline other than emergency funds. But you know what I mean? Like, there should be a buying opportunity when those events happen.
Mm-hmm. Mm-hmm. All right, that's a wrap for today. Thanks, Hao. Thanks, everyone, for tuning in today. We will catch you again in 2 weeks for episode 52.
All right. Thanks, Chris.
Talk to you soon. Bye.